Hi, I'm James Dunn. Welcome to the Inside Network.
Welcome to INDepth, brought to you by the Inside Network, and today my guest is Chin Liu, Managing Director and Director of Insurance-Linked Strategies and Quantitative Research and Portfolio Manager at Amundi Pioneer Asset Management in Boston. Welcome, Chin.
Thank you, James.
Chin, can you give us a description of this asset class, insurance-linked securities, a brief description of what the asset class is, and how did Amundi Pioneer become involved with insurance-linked securities, and how did you become involved with this type of security?
Insurance-linked securities essentially are financial instruments that transfers insurable risk into a financial security where the performance of the security is driven by the occurrence or non-occurrence of a large-scale natural disaster. So fundamentally speaking, it is uncorrelated with the traditional asset class. Our involvement in the asset class was back as early as 2006. As we know, after 2005, it was a very, very active hurricane season in the U.S. There were Hurricane Katrina, Rita, and Wilma. Altogether, those major events wiped out significant amounts of reinsurance capital from the system. So the insurer and reinsurers need to pay much higher premium to really attract additional fresh capital into the space. Our CIO has always been a value investor. So after the premium spiked during the January 2006 renewal period, he observed and noticed the opportunity, and that's where we started research and to try to understand the asset class. It took us quite some effort to get the approval from our investment committee, our management committee, and really pave the road for regulatory approval at that time. And we started investing in IOS with 40 million capital with allocation in one fund. And as time going on, as of right now, we have about more than 1.5 billion capital in this asset class with allocation across almost 30 different accounts. So it's a quite interesting and successful journey for us. Personally, I joined Amundi Pioneer back in November 2007. And to be honest, when I joined Amundi Pioneer, I was really a junior generalist on fixed income. And very quickly, 2008 came. You really just try to lay your head low and do whatever you were asked to do. And just coincidentally, I was assigned to perform some analysis on some cat bonds. That's really where I started, engaging in this asset class. But then as time going on, I think I built my knowledge, I built my experience, and I really, really enjoy the nature and then the challenging working on this asset class.
So, Chin, is it fair to say that effectively these are securities by which insurers transfer their risk out into the capital markets, and investors like yourselves buy the paper to take some of that risk for a return?
Precisely.
So does that mean that it is a form of investment for Amundi and other investors that is not correlated to the traditional financial markets?
That's correct. As we just described, the driver of the performance of those securities are the occurrence or non-occurrence of large-scale natural disasters. So we often joke saying, earthquake does not cause financial crisis, or financial crisis does not cause hurricanes. So fundamentally speaking, the performance of insurance-linked securities are structurally uncorrelated with the broader financial market.
Has that non-correlation always worked?
To be fair, that's where we say it's low correlation, but not non-correlation. In extreme times, for example, in 2008, when the entire market sold off, we still observed some selling pressure for IOS. Again, the overall performance of insurance-linked securities back in 2008 was still very attractive, but there was some selling pressure driven by the overall broader market.
The design, Chin, it appears to be one of those really nice win-win situations where the insurers get the benefit of other people picking up some of the risk, and the people picking up that risk get a really good, attractive, risk-adjusted return from a different source.
That's correct.
So what is Amundi's philosophy on the market? I imagine, like any other market, there would be participants who have different philosophies to others. So what's Amundi Pioneer's insurance-linked securities philosophy?
Sure. That's a very good question. I think before we ask our philosophy, a question I'd like to ask ourselves or ask any investors before you make your decision is, what information advantage do you believe you have against the market or against your peer? If you don't believe you have any information advantage, as we all know, very popular, you go beta. You just take the market beta. But if you believe you have information advantage, then you try to take that advantage. So for insurance-linked securities, we just simplify that into a two-axis challenge. One axis is really the risk distribution. We don't believe either Amundi Pioneer or anyone in the market would have the capability to forecast whether there's going to be a large-scale earthquake or hurricane within next 12 months horizon. In the end, that's why people buy insurance, because of the unknown. So we don't believe we will be able to add value for our investors by aggressively playing around on the risks, either increase our risk allocation to California earthquake or decrease our risk allocation to Florida hurricane. So our goal there is really to build a very diversified portfolio that mimic the risk distribution of global reinsurance industry. So we do not deliver a big surprise to our investors. When there is a large-scale Florida hurricane or there's a large-scale California earthquake, the industry will lose and we will lose. On the other side, at Amundi Pioneer, because we offer full spectrum of investment solutions to our investors. So we have full-time dedicated sector analysts focusing on insurance. So we have altogether 4 analysts, 2 equity, 2 fixed income, and 1 each on each side of the pond. So they provide tremendous information regarding the quality of the underlying sponsors, regarding the motivation of the underlying sponsors, whether they are doing this transaction because it's being required by regulators, they're trying to hedge some of their capital need, or it's just simply a transaction they can arbitrage the market by underwriting risk at a higher premium and ceding it out at a lower premium. And clearly, the latter case is a situation we try to avoid. So we try to really leverage the knowledge from our fundamental analysts, and combined with our proprietary tools to really identify, or to avoid the losers. In this situation, I think for this asset class, it's not about where I can find the winners. We want to have very broad exposure. We want to have very broad relationship with many sponsors, but our goal here is really trying to avoid, those transactions that would absolutely be a loser, in the universe. So that's, I think, slightly different approach compared with many of our peers who are really trying to identify, whether they want to increase earthquake or decrease hurricane.
Chin, it's an important question to ask about the role of these insurance-linked securities in portfolio construction. So where do they sit? Is this ultimately fixed income, or is the more natural home for it the alternatives allocation?
I think we have seen investors allocating on both ends because of the coupon nature of the security. Some people allocate it as a surrogate for high yield bonds or bank loans in their fixed income portfolio, because the long-term expected return nature of insurance-linked security is very similar to that of either high yield or bank loan. But for other investors, if they have a dedicated alternative bucket, they tend to use insurance-linked securities in their alternative bucket. So again, as we discussed before, driven by the uncorrelated nature, this asset class is truly fits very well in the alternative bucket.
What is the characterization of the return stream that comes from this kind of investment, Chin? Are we talking about equity-like returns or something between a fixed income equity style of return?
I think over long term, it is more between fixed income and equity. That's why we see the competing asset class is more like high yield bonds or bank loans. So sort of on the higher return spectrum of fixed income, but lower than equities.
So it would suit a growth defensive style allocation?
Probably not for growth stock, but I would say probably more for a value stock.
So your marketplace of institutional investors allocating into this with you as manager, has that been clearly? You mentioned before the amounts under management that Amundi have had in this have grown in a spectacular rate. Across the market, is there a similar growth in the rate of take-up by institutional investors of this kind of security?
Yes, I think generally speaking, we have observed higher acceptance rate for insurance-linked securities or cat bond. That reminds me a joke we had about 13 years ago, where we had to explain to people what cat bond is. It is not a dog bond. But right now, when you are talking to investors about cat bond, about the IOS, at least they are very much aware of these asset classes. It becomes more and more a mainstream asset class compared with where it was 10, 15 years ago.
Chin, can you explain how the securities have performed in recent years, probably say 3, 5, and even 10-year numbers, in terms of the return profile and whether they've demonstrated that they really do deliver the low correlation that is the promise of the asset class?
Absolutely. I think we had a few observations. As we mentioned, the correlation was low back in 2008 when everything sold off, when correlation went to 1. This asset class maintained its value fairly well. And a recent example was really March 2020. As we know, because of the pandemic, everything sold off. Our cat bond holdings, our insurance-linked security holdings in the multi-sector portfolio performed extremely well. Now, not only providing a diversifying source of return for the portfolios, but also providing a diversifying source of liquidity for the portfolios. I would say over last, call it 3 years, it has been a little challenging, really driven by the large-scale natural disasters we had observed in 2017 and 18. As we mentioned, this is not a risk-free asset class. It has its own risk characteristics. When there are large-scale natural disasters, investors will experience losses. And that's exactly what happened in 2017, which was one of the worst ever in human history in terms of insured losses, driven by, in the U.S., Hurricane Harvey, Irma, Maria, and also the California wildfires. But one thing I want to emphasize is that the asset class itself, insurance-linked securities, might be new to investors, but the underlying business is never new. Human beings have had insurance probably more than 150 years, way before we had even the equity market. So this asset class has actually been tested in many rounds, in many different market conditions, and under different type of natural disasters. So it is an asset class that has been very well established and tested.
Is it totally natural catastrophe insurance, or do these securities have in them some of the more exotic risks that may come out of the Lloyd's trading floor, like insuring space stations, etc., that kind of exotic risk?
Yeah, that's a good question. So our portfolio is primarily driven by natural catastrophes, but we have also very small allocation to, you just mentioned, marine and aviation. And also we had very, very small allocation to health and pandemic. So public news, we lost very small amount of money, driven by the pandemic, a bond that's sponsored by the World Bank that supports World Health Organization when there's a pandemic was triggered. And then the proceeds were used by World Health Organization to preventing, further spread of the pandemic.
Can you describe, Chin, the outlook and the trends for this asset class? It's fairly clear that you have to spend a lot of time looking at extreme weather and those kinds of analysis. So how do you look forward in this asset class and try to pick the trends and the outlook?
That's a very good question. In a way, I think probably this is one of the very few asset classes where the fundamental research was actually paid by the taxpayers. We are heavily relying on the government agencies, for example, in the U.S. National Hurricane Center, or on hurricane, or USGS on U.S. earthquake. So those costs of those entities are all funded by taxpayers. And as we mentioned before, we do not believe we are able to forecast the occurrence or non-occurrence of a large-scale natural disaster within the next 12 months. So we do not really aggressively jump in and out of certain risks. But at the same time, we acknowledge the global warming, the weather change. So we want to make sure that we incorporate the latest event, the newest information in the modeling process. So we very carefully perform our due diligence to make sure that we fully understand the risk we're taking and we are fully aware of the exposure we have in the portfolio.
Thank you, Chin. It's a fascinating discussion.
Thank you, James. Thank you for having me here.
This has been INDepth, and my guest has been Chin Liu, Managing Director and Director of Insurance-Linked Securities and Quantitative Research and Portfolio Manager at Amundi Pioneer Asset Management. Thanks, Chin, and have a great day.
Thank you. Take care.